Hello, today I'll be presenting on sensitivity analysis as a tool for capital budgeting. The goal of this session is to explain how organizations evaluate risk when making investment decisions, and how both quantitative and qualitative factors are used to improve decision making. I'll walk through the purpose of financial management, the steps involved in sensitivity analysis, and how risk is integrated into capital budgeting decisions. The primary goal of financial management is to maximize the value of the firm. This means making decisions that increase shareholder wealth over time. To achieve this, financial managers allocate capital to projects that generate the highest return relative to risk. They also work to maintain liquidity, ensuring the company can meet short-term obligations while still focusing on long-term profitability. Every investment decision involves uncertainty. Because of this, risk management becomes a critical function. Tools like sensitivity analysis help managers understand how changes in key variables impact financial outcomes, allowing for more informed decisions. Sensitivity analysis is a technique used to evaluate how changes in one variable affect the outcome of a financial model. It is commonly used in capital budgeting, particularly when calculating net present value or internal rate of return. The purpose is to test what-if scenarios. For example, what happens to a project's profitability if sales decrease or costs increase? By adjusting one variable at a time, managers can identify which factors have the greatest impact on the project's success. These high-impact variables are considered key risk drivers and deserve the most attention during planning and execution. Conducting sensitivity analysis involves a structured step-by-step process. First, key variables are identified. These typically include sales volume, pricing, operating costs, and the discount rate. Next, a base case scenario is established using the most likely assumptions. From there, one variable is adjusted at a time, usually by a fixed percentage, such as a plus or minus 10%. After each adjustment, the net present value or internal rate of return is recalculated. The results are then compared to the base case. The variables that cause the largest change in outcomes represent the greatest source of risk, and they should be prioritized in decision making. While quantitative analysis is essential, it does not capture the full picture. Qualitative factors play a critical role in evaluating risk. These include market demand uncertainty, changes in the competitive environment, and potential regulatory impacts. For example, a project may appear financially strong, but if market demand is unstable, the actual risk may be much higher. Operational flexibility is another key factor. A project that can adapt to changing conditions is generally less risky. Additionally, the experience and capability of management can significantly influence project success. In practice, quantitative analysis tells us what could happen, while qualitative analysis helps us determine what is most likely to happen. Sensitivity analysis is just one of several methods used to integrate risk into capital budgeting decisions. Scenario analysis expands on this by evaluating best case, worst case, and most likely outcomes. Monte Carlo simulation takes this a step further by using probability distributions to model a wide range of possible outcomes. Another method is the risk-adjusted discount rate, where higher risk projects are evaluated using a higher required rate of return. Break-even analysis helps determine the minimum level of performance needed for a project to be viable. Together, these tools allow managers to move beyond simple projections and incorporate structured risk analysis into their decisions. Risks in capital budgeting can be categorized as either internal or external. Internal risks originate within the organization and include factors such as cost control, organizational or operational efficiency, and project execution. These risks are generally more controllable. External risks come from outside the organization and include changes in interest rates, inflation, market demand, and overall economic conditions. These are largely uncontrollable, but must still be accounted for. Sensitivity analysis helps managers understand how both types of risk affect project outcomes, allowing them to prepare for uncertainty and make more resilient decisions. To illustrate how sensitivity analysis works in practice, consider a project with a base case net present value of $50,000. If sales decrease by 15% and the NPV drops to negative $10,000, this indicates that sales volume is a critical risk factor. This insight allows managers to focus their attention on improving sale forecast, strengthening marketing strategies, or building contingency plans. The key takeaway is that sensitivity analysis helps identify where risk matters most, enabling better, more informed capital budgeting decisions. These are the sources used to support the concepts presented in this training session. Thank you for your time and attention.